everyone. My name is Nick, and I'm on the Vancouver Startup Week team this year. First of all, I'd like to take a moment to acknowledge that we are grateful to be virtually gathered here today on Indigenous land, regardless of where you are joining us from. Personally, I'm grateful to be on the traditional unceded territories of the Musqueam, Tsleil-Waututh, and Squamish peoples. Unceded means these territories were never handed over, sold, or given up by these nations. And I'm, firstly, I'd also like to thank you all for joining us for Vancouver Startup Week 2021, and welcome to the session today with Boast.ai, an entrepreneur's guide to fundraising. This session is part of the VSW growth track and is proudly supported by Innovate BC. Innovate BC is a Crown agency that provides small businesses around the province with funding, business coaching, and educational content. They're helping entrepreneurs and founders start and scale their businesses and adapt to the changes brought on by COVID-19. If you're looking for support for your business, make sure you stop by their booth to learn more about how they can help you. For our attendees in the audience, if you have any questions for our speakers, please post them in the Q&A in the Whova session. You can also upvote any questions that you find are particularly relevant. So I'll now pass the mic over to Russ and Eric from Boast, and we'll begin the session. Thank you.
Awesome. Thanks, Nick. And on behalf of Russ, myself, and Boast, we're happy to be here and always happy to be part of Vancouver Startup Week. Hopefully this is the last year virtually. We look forward to seeing everybody in person again soon. But really quickly, an intro from our side. My name is Eric Rice. I'm joined by Russ Armstrong, our VP of Sales and Strategy. And quick intro on Boast before I pass across to Russ. We focus on R&D tax for our clients, and specifically here in Canada, that's SHRED. And we use technology, use software and engineers to automate the SHRED process, A to Z for our clients, start to finish. So if anyone
Well, I don't know if that's just me or I can't hear you suddenly, Eric. I'm not sure if that's just me.
Did I go?
There you go. You're back now.
The usual, didn't pay my internet bill. So I'm not sure where I cut off. I was probably in the middle of my intro, but maybe what I'll do is not do it again. But let Russ or I know, we make it easy. That's the quick one, but I'll pass it to Russ before I drop off again. He's awesome. I want to do a good intro. We'll see if it cuts off, but he is awesome guy, has a ton of finance experience, and he leads our sales team here at Boast, but he also was a co-founder of Limelight and went through founding a company, raising funds. I think they raised 10 million, Russ, and he's going to walk you through that journey and some of the things he learned along the way.
Yeah, awesome. Thanks very much, and excited to share with everybody here today. Yeah, as Eric mentioned, I put this together after kind of going through my own startup journey and really started to build out some content to help other entrepreneurs really figure out how this all works, and a little bit of a background on myself. I came from the finance world. I came from RBC Capital Markets. I was an institutional equity trader for 11 years, and I thought that would give me this huge advantage in fundraising. And my God, the public markets are very different than raising money as an early stage entrepreneur. There were some parallels. I could use Excel really well, but I had a lot to learn to kind of figure out how this all worked. So, I went and joined Limelight. We raised, I think we've raised about 13 million to date today. And I was one of the co-founders. I ran finance and sales there, and really it was a big transition for me going from a big enterprise like RBC, I don't know what there is, 88,000 employees across the world, to being a co-founder where it was me and my co-founder looking at each other, Spider-Man pointing at each other, like who's doing what, where's going where, right? And that was really, it was an eye opener to really get off the ground and start going. So share some of my stories with that and how it worked and how we kind of got to where we did today. And then, yeah, as Eric mentioned, I'm currently at Boast. I joined Boast team about 2.5 years ago. And, one of the reasons I really like Boast is just us, kind of our philosophy. We really like to help the community in the ecosystem, not only through getting Shred easier, but through our Traction webinar. As you can see up here, we throw our Traction webinar series where we get incredible speakers. We do 2 a week. If you're not signed up for it already, sign up for it. We get, Jeff Lawson was on it, CEO of Twilio, about a month ago. We get some of the most incredible speakers, and they just giving tips and hacks and across all your segments. So really valuable content that's all free. So sign up for that if you haven't already. But yeah, let's jump into it. And it's kind of what I was talking before. When I left capital markets and I got into Limelight, I really thought fundraising was pretty easy. I kind of had it mapped out. I'm like, yeah, I'll go to an accelerator and sell a little bit of my company, and then after that I'll do a seed round, sell 20%, maybe 3 at 15, and then I'll get to a series A and I'll sell another 20%, just follow the standard path of what a lot of companies do. And then I started to get into it and really researching it. And I was like, man, there's a lot of stuff going on here. There's like friends and family rounds, there's accelerators, incubators, angels, angel groups, pre-seed. I'm like, all right, well, I don't even know who to target. And, that was one of my first questions I had to kind of figure out. And then second, it was like, am I doing safes, convertible debts, venture debts, equity rounds, price rounds, revenue financing, government grants? There's all these different questions that I was like, man, I wish I was a CEO that could help me with this. And then I was like, oh shit, I'm the CEO. So I got to figure it all out, right? And, if you guys are overwhelmed trying to navigate this, I came from a finance background and I was overwhelmed too. So don't be shocked by it in any way. So, this is what I kind of mapped out after the fact. So this was like my timeline. And I found this super useful to kind of write this all down. And it's this is what our fundraising kind of timeline looked like. From a friends and family round back in 2014. This was the instrument that we did, our pre-money valuation, how much money we raised, what multiple that was, what our MRR was during that time. And then, an angel round, we went to an accelerator, we did some Shred advanced funding, we did a convertible debt, another convertible debt. And I'll go through this in a little more detail with everybody, in the presentation today, so we can get a little more clarity on it. But, and feel free, there is a Q&A in here too, so maybe we can get to the Q&A at the end. So feel free to pop some stuff in there, and maybe we'll circle back to the Q&A after, because I know there's a lot to take in right here. So, but based off of that, this is kind of the map of what got us here and got us to our point. Now, I was laughing with one of our team members the other day because the multiple expansion is really different today than when I was fundraising. We're seeing multiples that are way higher than this, depending on your sector. And I'll get into some of that as well further on in the presentation. But this kind of gives you an idea. And these were only executed rounds. This didn't even have to do with term sheets that we might have got and turned down because we got better ones. So, and this doesn't even include all the government grants that I took advantage of. The only one I've really highlighted here is Shred, just because of how massive it is. But there was wage subsidies for, early grads, new grads, co-ops, took advantage of numerous of those grants as well to help us staff up and gain more resources throughout our process. So we'll dive into that a little bit further, but first I want to kind of start off is, any of you fundraising out there, I can't stress this enough. Fundraising is hard, like very hard, like not just a little bit hard. Let's dive into a little bit. I haven't had a chance to update it with the 2020 numbers yet. I know the CBCA has populated that now, but this is pretty much what's going on. Like, everybody is so excited. They're like, oh, there's so much money in VCs and they're, it's growing exponentially every year. And I'm like, yeah, that's kind of cool. But you know what also is happening? The number of people competing for those exact same dollars is also skyrocketing. So it's not like there's frothy money flying around everywhere. There's just that many more people competing for it, which makes it that much more tough to get it. So it's not that much easier to get it. It is a great time to fundraise in the Canadian ecosystem and the US ecosystem. That is for sure, but that doesn't make it easy. It still makes it very difficult, and there's a lot of competition for it. In 2019, if you break out the data, this is kind of the Canadian landscape. So the Canadian Venture Capital Association, they got a full playbook on this. You can kind of look it up if you want more details on it. But there's a big weighting. So when they talk about this huge volume of dollars going out, There's also big companies raising, like, look what Wealthsimple just did. They just raised a $750 million round. That is going to shatter records in 2021, but it's going to be one deal that caused it to shatter records. And you know what the media is going to do? The media is going to spin it. Oh my God, there's so much money out there. Look at the record we set, but they're not looking at the details. You got to look at the details. So let's look at what's actually happening. Below the $5 million mark, 6 out of every 10 deals were done there. But if we want to add these up, there's not that many deals that are actually going on below that. So there were 116 deals less than $1 million. That's not very much. 116, if you're out there competing for an angel deal, a pre-seed, only 116 are going to get done. That's a tough market. So you got to think about it that way. And the second way I like to think about is just on a bell curve. If we think about the distribution of deals, and what do I mean by that? If you're at the top end of the bell curve, you're an outlier because your metrics are really good. You're growing like crazy. You're growing 300% a year. You've got traction, you've got logos, you've got a product. Your fundraising process is going to be a lot easier, but you're an outlier on the other side. Do you know who we typically see in the media and that we see on podcasts and we see on traction webinars? We see people who are very successful, but the very successful people, it's like your Instagram, you know what I mean? You always see the good things on people's Instagram account. It's the same thing with fundraising. The people who get the speaker slots are the people who just raised a $750 million round. They're an outlier. There's one company that did that in Canada. That's it. The majority of us who are fundraising are in this world, the middle of it, where we got to work hard, really hard to raise money because our metrics aren't that good. Maybe our industry is not as sexy. Maybe it's been ignored previously. Maybe our TAM's not that big, whatever it might be. And then there's the bottom half. You know, the bottom half who are really good, they're really good storytellers. They're amazing at telling stories. They're amazing at getting their conviction across. And they have a very compelling fundraising strategy to help them fundraise. Because you got to be scrappy to fundraise at the bottom end of the curve. But you can still do it, but you have to be scrappy. All right, we'll dive into that a little bit more. So what do I talk about fundraising strategy? What is a strategy? Like, isn't it you just go pitch some people? Well, kind of, but kind of not. The key component of a fundraising strategy is the first thing you do is need to know what your company's worth. If you can't put a value on your company, how do you go fundraise? You can't. You don't even know what you're asking for. And I know a lot of this is like, man, this is just like pie in the sky made up. That's fine. You can make assumptions about why you have a certain valuation, but I'll make it more clear why you need to do that as we kind of keep going through this. And what are the key drivers of your valuation? Because this differs across different industries. If you're in a SaaS model, it's an MRR multiple, monthly recurring revenue. You put a multiple on that. If you're more B2C, it's going to be like active monthly users or active downloads, that type of thing. If you're a marketplace, it could be transaction volume. Like there's different metrics for the industry you're in, but you need to understand about how those drivers impact your valuation. Say your pre-rev. Well, your pre-rev might be a certain milestone that you achieve. That milestone could be like shipping an MVP, getting your first free users on the platform. Those are milestones that also impact your valuation. Because let's think about it. Are you worth the same prior to launching an MVP as post? No. So that is a milestone that changes the valuation of your company. And the reason we're thinking about this is because we need to create leverage so investors want to invest now and not later. And that is by having a story around what your milestones are and how your valuation changes. Because everybody wants to, buy low, sell high. That's how it works. But if you don't know how your valuation is changing, you can't tell a story to an investor that you can buy low now and it's going to be higher later. And you need to create that leverage throughout your story. So things you need to do kind of to match your milestones, you have to adjust your milestones to match your cash on hand, because that's another big component. How much money, how much runway do I have? Do I have 3 months of cash on hand? Do I have 6 months of cash on hand? And sometimes you need to adjust those milestones to match how much money you have, because you need to fundraise by a certain time. Because otherwise you got to raise additional cash to hit those milestones. And this is kind of what I mean by that in a graphical form. So, when you go and raise money, you have your pre-money valuation. Your post-money is defined in a calculation, say you're worth 1 million and you raise $500,000, your post money is 1.5. But you start dwindling that because that's your burn and you're running money. You want to rather move this milestone over before you run out of cash, so you can go raise again and you've hit your milestone, which is your next valuation inflection point, which raises your valuation so you can go out and raise at it. Or you need to adjust your burn to last the money that would last longer so you can go out and hit that milestone later on. But these are kind of some of the concepts you need to understand when you're talking about valuation to investors. All right, let's talk about valuation a little bit. So, if you're in a SaaS business, which Limelight was, we were a enterprise tool that helped marketers at large enterprises measure their experiential marketing. Experiential marketing would be live experiences, like an auto show, a test drive, any type of event where you're experiencing the brand and something about the brand live. In our industry, it was very much a rule of thumb around it was anywhere from 6 to 9 times. And this is dating me a little bit because I've seen multiples at 20x in certain hot sectors right now. We can talk about that a little bit. But generally, if you're in that middle pyramid where your growth rate is like meh, where you're in the middle of the bell curve, 6 to 9 is a very fair multiple for raising funds. So some of the other things that change the multiple that you could get, and it could be a multiple on your active users, on your revenue, whatever it might be, but what is the multiple? What is that driver where you can have a formula written down that describes what your valuation is? And some of the changes to those multiples are your total addressable market. Are you servicing a niche market, or are you servicing like Uber and it's like every driver in, across the world is your total addressable market? Or are you a niche of it? Are you creating a CRM for dentists? That's a very niche market, a lot smaller. That affects your multiple that you're going to get. Your team. Team is extremely important, and the rule of thumb I see is second-time founders always get a premium on their multiple than first-time founders. Just from the experiences, the pitfalls, the challenges that they go through, the success ultimately is higher on second-time founders. Therefore, they get a higher premium when they're going out and fundraising. The timing of the market. So, this is a great story. We were a marketing technology company. Martech was a big deal. Like 2005 to 2010, Martech was the heyday. They were raising Martech funds in the US left, right, and center. There was money flowing around. And then we come along in 2015 and we're like, hey, we have a Martech play. And they're like, everything's been done in Martech. It's out of favor. All the VCs have already tapped all their resources. They didn't have a lot of money left over for new investments into the Martech space. Our timing was off. And that affected our multiple because there just wasn't as much interest. Because, if you want to follow economics, supply demand, if there's not a lot of, supply of cash to fund those ideas, there's not a lot of demand. Your multiple goes down. You're just not going to see the same type of thing. So, that timing thing is a big component of it. Same as today, like crypto, blockchain, fintech, those are hotter sectors right now. People want to talk about those. There's fresh funds, Portage just upped it. Radiant just upped their deals. So there's lots of money in that space to go around, which means that it's a little bit frothy and people will pay premiums in that. Oh, that's the wrong button. There we go. Sector. I kind of just touched on that a little bit in terms of sector. Like, what sector are you on? Are you Martech, fintech? The biggest one is your growth rate. If you're growing 100% year over year, 200% year over year, 300% year over year, that is where it's really going to go. And those are the metrics that you really want to look at. And I can show this if I go back into the multiple compression with that guide, which I'll show a little bit later. We can talk about this as our growth rate changed, because your growth rate, it's not linear. Your growth rate changes, right? In one year you grow this much, the next year you grow this much, the next year you grow this much. And those comparisons make a difference for how you're fundraising, because they're seeing, is your growth slowing? Is your growth accelerating? And you see this in the public market also. Like if you look at some of the big hot stocks out there, Snowflake, if anyone follows the public market, that's a big data play. Snowflake trades at approximately 40 times revenue, but that's a ridiculous multiple, but it's growing 100% year over year, and they're at approximately $1 billion in revenue. That is mind-boggling. They deserve a 40% multiple or 40-time multiple. So really, that growth rate is a huge catalyst for it. And logos. What do I mean by logos? When you're fundraising in those early stages, those logos are those proof of concepts from key customers, will get you in the door, and they will get you more attention. Example we had, and it's a great story we have with Limelight. When we were fundraising, we got invited down to pitch Sequoia. We had a deck fired to the B2B SaaS principal at Sequoia, and he saw our deck and he's like, I want to meet with you guys. And we were like, well, that's cool. We were looking at each other kind of dumbfounded by it because we did not expect to get in the door there. And we got down there and we got into the room, and it's the most beautiful headquarters I've ever seen. It looked like a country club golf, a clubhouse. And it was wicked awesome. We go into this room and they have all the tombstones of all the deals they've done and IPOs and exits, and you're just like you feel like you're in the Hall of Fame when you're in their office. And the head of the B2B SaaS sector comes in and he sits down. He's like, apologize off the bat. I don't have a full half an hour for you guys today. I've been really busy, but I really wanted to meet you guys because I have a couple questions for you. He's like, can you go to slide 5? And slide 5 was our logo slide. It was like, these are the companies that are paying us. And he's like, can you tell me exactly what these companies are paying you for? He didn't care about anything else in our deck because he just knew everything else that was going on in that sector. So he was just so plugged in, but he wanted to know if he was missing something about what these brands were paying us for that he hadn't thought of before. And he would have made his decision on the bat. If it was the right answer, he would have invested in us. If it was the wrong answer, he was out because he didn't care about the rest of the deck because he already knew the rest of the deck. But that logo got us in that door. So that proof of concept, that initial logo, that MVP, regardless of the paid aspect of it, you can create a story around that. The use case for that logo is so important for you to get those meetings. That means there's traction. That means there's some understanding that there's some value you're creating, either if them buying into your future product or buying into your current product. But that logo means a lot to kind of get you through that fundraising process. All right, I kind of touched on this earlier, like your valuation is not linear, your growth rate's not linear. All these things happen and change, and you're going to go through ups and downs and cycles with it. So this is something to keep in mind while you're fundraising. All right, a fundraising process. So what does it look like? It's a sales process. That's pretty much what it is. I always pitch this all the time to people. Your buyer persona is a VC. And what is that VC? Is it the principal? And then what is the mandate of that fund? Is that fund investing in your sector? If you're a MarTech company and you're pitching a FinTech VC, well, let me guess what the answer is going to be. You're not going to have much success. So whatever sector you're in, you're going to want to say, hey, I want to have at least 100 FinTech investors. If I'm FinTech, I want at least 100 FinTech investors at the top of my funnel because that's my awareness campaigns that I want to get people excited about my story and what they're doing. And then set up a drip, a cadence, a sequence against that to bring them on a journey of what you're doing. Again, this is a sales process. So you are literally going through it. And the whole idea is if you go down your funnel, if you have 100 people at the top, 20 people might express interest, you might get 5 meetings, and you might get 1 term sheet off the back of those 100 activities. And that's the whole idea. If you think you're going to send out 5 requests for an investor pitch and you're going to get a deal, you better be at the top end of the bell curve. Because if you're not at the top end of the bell curve, you're not going to get the success you're looking for. The lower you are to the bottom half of that bell curve in terms of your funding, your metrics, your attractiveness of the story, you can still fundraise, but the harder it is and the more work you're going to have to set into this process. Always be prospecting. What do I mean by that? I mean, ask questions. Ask questions when you're in an interview or in with a VC. And some of those questions can be around, if you're pitching a FinTech space, ask them about their, the fund. Do you have still money that you're allocating to first deals, or they all follow on deals at this point? Or ask them, have people been talking about this thesis that I'm solving or this problem or solution? Ask them for feedback about what you're actually working on and what you're solving, and ask for maybe referrals. Because if you think about what a traditional VC does, especially some of the larger ones, they are think tanks. They are actually proactively outbounding to areas where they have a thesis that there is a problem and a solution that needs to be solved. And the idea is there's probably some tech startup out there that's solving the problem that they want to invest in, but it's a matching problem. How do you get matched up with that VC? By some of that is always asking questions like, do you know people who are looking for a company that is solving this problem? Because that might lead to more introductions, add more people to the top of your funnel where you're going to actually match off on that. Work backwards from your metrics. So work backwards is kind of like, what is your path to those milestones look like? So it's similar to the chart I had. What do you think yours might look like? Do you think that you might be raising at a 2 million val? What dollar value do you want? When you're going out to your Series A, what do you think that's going to look like? Work backwards from those metrics. It's not going to be perfect and it's going to change, but it gives you a good understanding of what your milestones you're going to need to achieve to deliver against what a VC actually wants you to say. Have your FOMO story. So, the fear of missing out. That's the biggest thing with most investors is, they don't want to miss a good opportunity. They don't want to miss the next unicorn. They don't want to miss that opportunity. Like they talk about deal flow as some of the things that they worry about. When there's a hot deal out there, they get cut out of deals because everybody wants in it. So what's your FOMO story? How are you creating fear that they're going to miss out on an opportunity? And this a lot turns into how you actually pitch your solution. So if your pitch within your pitch deck is, I always like to talk about it, you're pitching that your solution is inevitable and it's going to happen with or without their help, that's the kind of FOMO you want to pitch with them. I don't need your help, but if you were to invest in this company, I will take it from 1 million to 3 million. My favorite chart in a pitch deck is your growth chart. So it's like, if I take no capital, I'm going to grow at a 15% return. But if I take your capital, I can do this and grow at 30%. Those are your best slides in a pitch deck because it shows that there's no urgency on your side, but it also shows that you have a plan and you have metrics against how you would allocate those dollars to grow faster. And that's your FOMO story of what you want to create. Term sheets get term sheets. And I talked about this earlier when we were saying, I didn't put in that chart all the term sheets I turned down because you're not going to take all the term sheets. So there's this weird period. So especially when you're negotiating and you're actually down the road with multiple investors, say you have 5 or 6 investors in your data room. Some of them are dragging their feet. Some of them aren't dragging your feet. One of them finally gets off and says, hey, here's a term sheet. In term sheets, there's actually a lockup period. So if you sign that term sheet, you're not allowed to go solicit other people with a signed term sheet. You're now locked into that deal. But before you sign that term sheet, I think as a founder, you have an obligation to go to all the other parties who are in that data room and let them know that you have a term sheet before you've signed it. So you're saying, hey, I have a term sheet and I'm going to sign it in the next 48 hours. You rather need to make a move and send me a term sheet also, or you need to get out of my data room because I don't need you anymore because I'm going to sign it. And you know what happens when that happens? FOMO happens. They think they're going to miss the opportunity. And that happened to us 3 times where a term sheet showed up on our desk the next day because another term sheet was there and they had FOMO and didn't want to miss it. So term sheets get term sheets. You just have to do it within a short window because you have that lockup period after it's signed. Plan B, which I like to talk about, is until the cash is in the bank, same with in sales, until they've signed the contract back to you, a verbal means nothing. So what is your plan B? A verbal doesn't help you. Verbals can break apart. Anything can break apart. You have to have a plan B. And what does that plan B look like? It could be cutting salaries. It could be a line of credit. It could be quarterly advanced shred funding where you take your money earlier, where you can extend your runway. It can be a lot of things, but it's plan B. What is that? And what do you have in place for that? All right. So just running through some of that. I don't know if there's any Q&A. I don't even know if it's enabled, but anyway, we can look at it after. So here's kind of my journey. I kind of walk through this a little bit from our perspective. So when we first launched, we did a friends and family round. We did a 1.5 pre-money valuation. We raised about 150 there. It was a 12.5 multiple. Really, this multiple really was because as you might hear from a lot of people, you need a base floor where you need to start from. If your idea is that you are going to raise capital because you're going to build a solution, you need a kind of pre-money minimum that you're going to work with for it to make sense. If you're half of that, you get diluted too quickly and you're not going to own enough of the company going forward for it to be worth your while. So there's kind of like a floor in place, and it can be somewhere between this 1.5 and $2 million valuation is kind of where I see this floor level that you kind of have to look at. For the next thing we did was an angel round, and we did common shares on that again. There was about, we did a $3 million valuation. As you can see, our revenue was starting to increase. It was about a 7.5 times multiple, and raised another 150. And then one of the best moves we did is we joined an accelerator. We joined Acceleprise down in Silicon Valley. Acceleprise is a B2B SaaS accelerator. They're fantastic. They got offices in Toronto, New York, and San Francisco. A great bunch of LPs and managing directors there, and great programming. So we joined them, and we kind of did a deal around the 7-time multiple. And this was on a convertible note. So similar to a SAFE, and we'll touch on that in a little bit. So here's just some early ideas that I'd like to talk about with this is I always had some tips early. We spun out of an agency, our idea. So some IP was assigned to people that weren't really carrying the company going forward. So here's what I mean. People would say, clean up your cap table. And I was like, well, what the hell does that actually mean? Well, it means that the people on the cap table need to be the people who are going to carry the company into the future. Meaning your co-founders need to have enough equity in the company for them to stick at it high and low, because no investor wants to invest in it when one of the founders doesn't have enough of it, because typically what happens at early stages is you don't pay yourself at all or very much. You work long hours, and it's very difficult. And if you don't have this lottery ticket equity stake in the company to gain on the upside, you lose motivation and you lose attention very quickly. And for an investor, that is a massive, massive risk. So clean up your cap table. That's what that means. And ways you can do that is issuing additional shares to the people who are going to drive the company forward, or a new class of shares. There's different options. You're going to have to get a lawyer involved to clean it up, though, to get it there. But that's what it means. And then your IP, even at your earliest stages, get your IP in order. IP agreements, employees should sign IP agreements to make sure that the IP is the property of the company and not a property of anything else. Everybody's seen, what was the Facebook movie? Was it called No, that was a different one. Remember, I don't remember the Facebook movie was.
Social Network, right? Yeah.
Social Network, that's it. Yeah. You don't want to have to deal with that and pay out people down the line. All right, so I'm going to get into convertible debentures and just a little bit of concept here around raising that. So you'll see we did 2 converts over a short period of time here. We did a common convert at a 5 million valuation, and then this converted it to a preferred share. This was our first institutional investor. So institutional investors, like a VC, they're going to want preferred shares. And the reason they want preferred shares is preferred shares have different rights than common shares. The primary one that they want is the liquidity preference. And the liquidity preference means that they get to get their money out before any common shareholders get their money out. And that is downside protection in the event that they need to sell for IP value or whatever it might be. They have a higher likelihood of recouping their principal than the common shareholders. That's liquidity preference. And you're going to have to start seeing different types of shares in that. Obviously, again, your bargaining chips change. If you're at the top end of the bell curve, you have a lot more to bargain with in terms of what your share structure looks like than if you're at the bottom end. If you have one term sheet, take it or leave it, you're kind of taking it or you're out of business. So really it depends on where you are in that spectrum and how good you are with your fundraising strategy. So all of these play into your outcomes. All right. So a lot of people talk about convertible debentures and SAFEs and what's the difference. So they are effectively the same thing. They are debt instruments that convert to equity at a priced equity round. So they're pretty much debt on your books until then. The pros of it is they're very easy and cost effective to get out the door. The negatives of it is they are unpriced. People actually don't know what they've invested in it because they're invested at a future cap. So it will be a cap where they wouldn't, the cap means that if you raised a Series A at 10 million and you have converts with a 5 million cap, the money they invested converts into equity at a valuation of 5 million, not the $10 million priced round on the Series A. That's what the cap means on that. The difference between converts and safes is, we were talking about, they're very similar. Safes were developed by YCOM, and the reason YCOM did it is they did safes because pretty much everybody graduating YCOM goes on to raise a priced round, like a qualifying round that converts the safe into equity. So YCOM can do this very easily. It's a short form document. They're not worried. If it doesn't work, it blows up. Converts are a little different, and the reason converts are different, it's a lot longer document, but it covers more scenarios. And what do I mean by that? Say you raised 5 million in converts or $1 million in converts, and you never raise additional dollars. Now you don't have a conversion mechanism outlined in your contract. You now have debt on your books that you can't remove because you have no mechanism to convert it into equity. And to me, that's a big flag, especially if it's friends and family, and you go back to them after 3 years and you're like, all right, let's negotiate how we're going to convert this. And they're going to be like, oh, well, I invested here, it's worth this much. And you're, oh, well, it's worth this much. It causes massive problems. I personally like converts better because it covers the scenarios that could possibly happen. But if you're going to YCOM and you're about to graduate, you can do a safe. So I think there's different scenarios and where some are better than others, but there is a difference between the two. Here's one of my best approaches when we talk about fear of missing out is really having this strategy. So if you know your valuation drivers are MRR and you're at 50K in MRR and you're saying, I'm going to raise at a $5 million cap, but if I'm linked my MRR to my valuation, I can say, once I get to 80K in MRR, I'm now doing it at an $8 million cap. Because that's fair. That's what my driver of my valuation is. It's my MRR. So if you go out as a fundraising strategy to say, I'm going to raise 50K at a 5 cap and 80K at an 8 cap, this creates urgency and it creates fear of missing out for your investors because they obviously want to invest at this. And if you go to them and be like, hey, I'm at 50K in MRR, but here's my pipeline. And based off of my pipeline and my metrics, I'm going to be at 80K in 3 months. And once I'm at 80K, I'm not raising at 5 anymore. I'm raising at 8. So you'd rather have to pull the trigger now while I'm at 50 and you can get a 5 cap. Or if you wait, you're paying this price. And it changes the tables. It creates urgency to the investment, which forces the investor to make a decision now, knowing that they can't drag their feet and get a free option and say, oh, well, you're at 80K. Now I want to invest at the 5 cap. Now, this isn't a strategy that always works, but this is why it's so important to understand how valuation and how you value your startup company. You need to understand how you draw parallels to what your drivers are to their valuation, so you can pull those strings in your fundraising process and your strategy when you're messaging this to your investors. All right, here's a great topic on shred advance funding. This is something that we took advantage of at Limelight, and it's really around, it's a short-term debt instrument, but it extends your runway and it gives you more bargaining power. And what it is I'm sure you guys know the shred program, but I'll jump into that real quickly. So it is the largest kind of startup incentive program in Canada. It's a tax credit where you can get 64% of your salaries back, 32% of your contractor expenses back, 42% of materials back, and you can get this back as cash. The problem with it is that you often have to wait 12, 15 months for it. But if you can access that cash early and earlier in your cycle, like on a quarterly basis, you can actually accelerate your growth rate, or you can extend your runway for when you're negotiating for that plan B when you're investing. So here's a little case study we'll walk through here. I got company A on this side, and they don't leverage shred advance funding. So they wait 12 to 16 months for their shred refund because they're like, well, I'll just get it when I get it. Company B plans to access their funds every quarter and reinvest it back into the company right there. Anyone in finance out there, they know compound growth rates. Well, this is compound growth rate. This is exactly what it's doing. If you're taking your shred advance funding and you're reinvesting it back into your company, you're getting compound growth. And that's what jumps it quicker. So here's the case study a little bit more broken out. what will the companies be worth in 2 years from now? So company A, again, they don't do the shred financing. They both started $100,000 in revenue in Q1 of year one. Over that 2-year period, they did their shred. Their growth rate was 15% without their compound growth rate, without reinvesting it back in. So they didn't start growing until they got the inflection point where they got their shred refund, where they could reinvest it back in their company, hire more dev, hire more sales, spend more on marketing, and they started growing at 20%. The other company took their cash earlier and started investing it back in their company earlier. So we were 100K after Q1 year one, but they got their first advanced shred refund at the end of Q2 of year one, and they started reinvesting it. And over that 24-month period, you can see the difference in their MRR at the end of the day. You had $289,000 of revenue for company A that didn't take advantage of it, and $343,000 for company B that did take advantage of it. Now, let's go back to what we were just talking about. How do you value your company? You value your company as a multiple on MRR. So based off of a 10x MRR multiple, company A is worth 11.5 million. Company B is worth 13.7. Now, what would you rather choose? I'd rather choose being worth more because you're going to dilute yourself less. You're going to have an easier time raising. Your growth rate's higher. It's actually a valuation difference of 2.5. So we talk about, well, what are the costs associated with it? The costs are negligible versus the valuation difference that you get with this compound growth rate as you accelerate quicker through it. So that's kind of the reason that you want to take advantage of that. So typically how they work, if you're going to take an advance on your shred refund, it's an operating line, and it's trailing quarterlies where, after your 1 quarter of spending it with your expenditures, you then qualify for 1 quarter of your shred refund. It's typically around 14% interest rate, 1% draw fees. You can do claims as small as 50K. And you can get up to 75% of your quarterly shred refund back to you every quarter. Turnaround can be super quick, and all the interest is capitalized and paid out once the shred refund comes in. So it all is paid out after the fact. You don't have to worry about it. Really simple process to kind of run through. And with Boast.ai, we actually do shred filing and the financing in one vendor. So you don't have to go chase multiple vendors. So it just makes it a nice seamless process. And we've got a platform that you can log in and see what's going on with your shred claim in real time. Lots of benefits on that side. Next thing I want to talk about. So you notice, actually, when I go this, we did shred advance funding every year, and we did it here. We did it every year because it just made sense to keep reinvesting in your company. If you have a growth rate, you can accelerate your growth rate. And that's when you want to take advantage of this. It's compounding your growth rate. So let's talk about our seed to equity. This was converted into preferred shares. Our pre-money val was 10 million and we raised 1.7. We had a 7.94 multiple. Our multiple was pretty consistent throughout if you actually kind of map it all out here. We were at that magic number. I always hear a magic number of 100K MRR. I think that's changed again from when I was in, fundraising. That used to be a big inflection point of 100K in MRR. I don't think it matters. I think it's more your growth rate, your sector, and other components that really matter more than that nowadays. But that was a big inflection point for us. And that was the rate that we raised at. So a couple things about this, like when you actually do this price round, the pros are valuation and ownership is defined, which is fantastic. Investors are likely to be more engaged. That was a good point. Some US investors, as I mentioned, when we got that first US investor, some of them are such big funds that they will write $100,000 checks as a placeholder on your cap table. So they have the option to invest in a Series A. The $100,000 is not enough money. It's not material for them enough for them to even pay attention to you. But it is a strategy that a lot of them use to get more deal flow and more options to lead rounds. It's the craziest loss leader I've ever seen, but that's how these guys operate. The whole VC model in the US is if 1 out of my 100 companies becomes a unicorn, I won. That's the game they're playing. They're not playing any other game, which is an interesting perspective. The cons of doing this price round is, my God, you have to rewrite your shareholders agreement, which is extremely time consuming, high legal costs. If you don't like reading legal jargon and you're one of the co-founders, you're going to like it because you don't have a choice. You got to read it. You have to give up board seats or control, and obviously you want to maintain control as long as possible. Board seats are fine, but it's the control component of it. The sooner you're giving it up, the sooner you're giving up that control. Lengthy DD process, so your data room is going to need to complete. You're going to have everything in order. If you're unorganized, creating your data room will be extremely painful. If you are organized on the financial side, so take your time to create the right folders and folder hierarchy within your G Suite so that you can actually find what you need to populate a data room. Otherwise, you're just creating unnecessary work for yourself. So those are kind of some of the pros and cons of that. So I've already talked about it's not always linear. So our growth rate started to kind of compress around here. You know, if you look at it, we went from November 2016, we were at 105 in revenue, to July 2017. We only went up about 15K in our revenue during that period. So it was kind of a slow growth period. We were on the verge of a very large contract, but we hadn't signed it yet. And we needed to go back and do a seed bridge round, or a seed plus round, as they might call it. And we had to throw in warrants as a sweetener to get this deal done, which was the only reason, you know, the multiple went up, but I think it was the warrants that gave them an extra boost to get it done at this level. And we talk about a down round or a flat round. So the way the math works, as we were talking about earlier, your post-money valuation is 10 plus what you raised, which is 11.7, which was our pre-money, and we raised another 600 at that. So that would be considered a flat round, but we threw in warrants. So you could almost consider it a down round. We didn't down round it because we threw in warrants instead of actually creating a down round. So just some interesting negotiation tactics on that and how that all works. And while we're on the topic of warrants, what are options in warrants? Well, typically what you're going to see from most investors in early stages, you're going to have to form an ESOP, an employee stock option plan. And an ESOP gives your employees upside in the company as you guys succeed. And it's often used as a negotiating chip for new hires to pay them less. Sometimes you can't pay them market, but if you give them a significant ESOP or stock plan, they will work for less than market because they're buying into the upside in the company. It's generally around 15% of the fully diluted float. That's quite a bit. And this usually comes out of the founder side of things. So pre-raise, where you'll have to pull this out of the percentage of shares outstanding. And you might have to top it up on additional rounds. So just because you did it one time, you might have to top it up in additional rounds because you've allocated all of it, or maybe you still have significant hires you need to make. Warrants, on the other side, are long-term options that are given to institutions, where your ESOP is for your employees. This is for institutions, and they're long-term options that are sweeteners on rounds. You'll see this in equity. You'll see this in debt deals and venture debt deals as well. All right, I'm going to jump into non-dilutive stuff real quick as we're running out of time here. So non-dilutive financing, I mean, that's the holy grail, is if you can find non-dilutive financing benefits. Those are what you want, because you're not giving up equity, you're not giving up board seats, there's no personal guarantees. And why you want to do this: extend your runway before a round, bring cash forward to hire for growth, optimizing your capital structure. So this is your weighted average cost of capital and minimizing your WACC. For any finance people out there, that's what your goal is. You can use it for capital expenditures, or use it during a negotiation. So I call this the plan B move, right? You're negotiating an equity round and people are dragging their feet. If you go out and secure a line of credit that gives you another 6 month of runway, go back to the table and be like, guys, if you don't close this today, I'm going to take out this debt facility and I'm not going to fundraise anymore, and I'm going to put it on the shelf. And I'll come back when my MRR is twice this and fundraise. And it's a bargaining chip, because fundraising is bargaining in a negotiation. So that's how it works. So those are some of the things that you can keep in mind. How I break this down: non-dilutive financing options. There's secured debt, which is the bank debt. There's venture debt. There's revenue financing. There's the shred advance funding. There's other government debt like SOFI and FedDev. And then there's other government grants. Those are the categories that I kind of bake non-dilutive financing options into. Secured debt, which is your bank debt, which is coming from your big banks, is typically an operating line. You're looking at 5 to 9%. And if you have, call it 150 in MRR, they'll give you 4 to 7x multiples. So they'll give you a 400 to 700K line of credit if you're at 150 in MRR. Some of these are not achievable for early stage companies, but that's kind of where it is. The red flags is if you have too much client concentration with one client. If 80% of your revenue comes from one client, that's a flag that they're probably going to shy away from. They like B2B business because it's stickier than B2C, churn's lower. If your gross margins are less than 65%, they want to see at least 65% in SaaS. Or if your churn numbers are high, again, that's a problem on that side. They also like to see institutional investors. Institutional investors means that there is a significant institution that's invested money who is likely to invest more money should things not turn out very well. The goal of debt is to return principal plus interest. They're not looking for pie in the sky becoming a unicorn. They're literally just trying to return interest and principal with low risk. And the risk is lowered if there's institutional investors involved, which makes it easier to obtain these services then. Venture debt is very similar, except the thresholds are lower, which means that the risk is higher, which means that the cost is higher. You're looking at anywhere 13 to 25%, I would even say, plus warrants for venture debt. Some of the other things are similar, but again, the risk is higher and they'll go lower down the market. Revenue financing is also an interesting aspect where you pay royalties of your revenue, and they will give you a debt instrument that you have to repay with the kind of principles of you have to pay the principal at one time, a one-time buyout, and one time's royalties. So it's like a 3x cost of capital. But another thing you can look at if you're at that state of it. Here is just a comp chart about where the different cost of capitals are: venture capital, private equity, revenue financing, shred quarterly advance, venture debt, and senior debt. And here are the different kind of cost structures here. Obviously, your cheaper options are on the right side, more expensive options are on the left side. So I know people are in search of the holy grail of venture capital, but truthfully, you want to take advantage of debt options as soon as you possibly can as a company. And that's kind of your cheapest cost of capital, which allows you to own the most of the company. Government debt, something to look at is FedDev. I'm not sure if there's one out in BC. There is one in Ontario. And there's one, this is also an Ontario loan, is Sophie, but I'm sure they have some other government debts out in the BC sector. You can ping Eric if you have any questions on that. I think we have a fund or a non-dilutive fundraising deck that you can get at Boast or from Eric if you want to see more of the non-dilutive government grant options.
Yeah, I've got a Western Canada specific one on our website, or ping me on LinkedIn or email me. I'm happy to send that across.
Perfect. That's awesome. Government grants, tax credits, obviously shred, which we just talked about. I mean, everybody should be and needs to be taking advantage of shred. It is the most popular one by far. IRAP's another really popular one that you want to take advantage of. And yes, there's more programs. If you go to the boast.ai website and resources, you'll find more of those options there. All right, here's some providers, because I always found this interesting, because that's great, you have all this information, but who do I go contact if I want any of this? So who lives in the venture debt space? Espresso, Firepower, Lighter Capital, Revenue Financing, Flow Capital, Tamaya Capital. I call this like the mezzanine venture debt. They're like in between the regular banks and the venture debt. You got BDC, SVB, and Comerica. And then your senior debt is your, the big five. And these guys play in Roynat, Scotia, BMO, TD, CIBC, RBC, even National plays in this space a little bit. For Shred Advanced Funding, Boast.ai, it's a self-plug, but we actually have a truly unique offering where we offer both services in one platform. So a great solution to check out. And then I also got to highlight EDC and how important they are to this. EDC does loan guarantees. So if you bring EDC to the table and you're negotiating with some of the debt providers, you can actually lower your cost of capital by bringing EDC to the table. So something to keep in mind as you're going through that. We're at 5 minutes here. So I know I've been talking a lot here. Yeah, I don't think the Q&A is enabled. So
from there, I guess I'll talk a little bit about our Series A. So we finally locked down a Series A. See the big bump in revenue. We finally had a contract come through. So we went from 120 to 180 on a monthly basis. It was a giant contract, but at the same time, we had to squeeze on our multiple. It was our lowest multiple we raised at. It's less than 7 on MRR to get this deal done. It was still a massive deal and a fantastic deal to get it done. But you know, that was kind of the life cycle of that story and where we were. Right after that, you know, this is kind of how it is. The best time to fundraise is when you don't need money, because you have a lot more levers to pull in terms of if you and when you're going to pull the trigger. And when you don't need money, that's also when the venture debt people come out. So they'll be like, hey, I heard you just raised a lot of money. Would you like venture debt also? And you're saying like, yeah, I might as well sign up for that now because you're not going to give it to me when I need it. So you signed up for it now. So same thing with any of other your debt options. Start your relationship, start your conversations early, get your paperwork in place, because by the time you need it, you won't qualify it for it anymore. So just some advice on that front. Get it while you don't need it. Lock it down, secure it when you don't need it. So yeah, that's about it. This is just more on our platform. You can contact us, get a demo. It's an AI-powered shred preparation, consulting, financing, and advanced funding in one platform. We've been around we're Vancouver headquartered. We've been around for, man, I think a decade now. I guess it was our 10-year anniversary. We didn't have an announcement, Eric. We missed that. I think it was a 10-year anniversary though, but we are Canadian-based and VC funded. We raised a $30 million A round back in December ourselves and are expanding quite rapidly across Canada and the US. So anyway, that's a story from my front. I know we got 3 minutes till wrap up time here,
Yeah.
but thanks very much. And if there's any questions, connect with me on LinkedIn, connect with Eric on LinkedIn. I got more decks and presentations that are free on my LinkedIn profile. If anybody's interested in seeing a SaaS sales playbook or a sales velocity playbook, I got lots of other stuff that you can check out on my LinkedIn profile. So feel free to connect.
Yeah. Thanks guys for the awesome presentation. We do just have 3 minutes left. There's one question on Whova. So the question, you basically just answered it though. Question is awesome material, but they can't quite read the slides on the Whova. So will the deck be available? So will this one in particular be on your LinkedIn or?
There's one just like this and some other ones as well on my LinkedIn. If you want this exact deck, connect, just reach out on LinkedIn and I can send it to you. If it's not the exact deck, but it's pretty close. So
sure. That's it. If anyone else in the audience has any questions, you have about 2 minutes to answer. Or if there's anything, any last closing thoughts, Russ or Eric, you guys had?
I'm scared to talk because I keep freezing. So Russ, you go ahead.
Yeah, all good. I guess the chat functionality is not activated on the Zoom channel, but yeah, nothing else in closing. You know, good luck everybody. I'll reiterate from probably one of my first slides. Fundraising is hard, and if you're doing it part-time, expect part-time results, and that's probably my best advice I can give anybody on that topic. So yeah, that's it. We'll wrap it up there. Good luck to everybody. Thanks for having me, and thanks for thinking of Boast and including us in this.